Welcome back to another episode of Investing Explained. Here's today's question. So, Michael Burry, who you referred to, became famous for being the quote-unquote hero in the movie The Big Short that I'm sure many audience have already watched. And in that movie that took place up to the crash in 2008, he made a very profitable investment betting against CDOs. And right now, he's comparing passive managed index funds, meaning if you buy, for instance, ETFs tracking the S&P 500, and he's comparing that with CDOs before the Great Financial Crisis. Now, if you're not too familiar with CDOs, it's short for collateralized debt obligations, which was really a lot of bad debt bundled together and sold as high-quality debt, and often roll into so-called subprime mortgages that blew up back in 2008. And yes, we have tried multiple times to get Michael Burry to come on the podcast to talk not just about what he saw back then, but also his view on passive index funds, and he even recently took a stake in Bed Bath Beyond. So definitely a lot of things to talk about, and we will definitely still try to see if we can get him on. But in the meantime, let's go back to your question here, Sebastian. If you look closer at the S&P 500, you have as many as 266 stocks. That was Michael Burry's count. More than half that was traded under $150 million. And why that sounds like a lot, it's not a lot if you compare it to the trillions with a T of dollars in assets globally that are indexed to these stocks. Now, there are many opinions on whether we are in the bubble or not, but here on the show, we multiple times talked about that we found the stock market overvalued, and I really haven't changed my opinion about that. But regardless, if we are in a bubble or not, one thing is certain. If we are in a bubble, the longer it goes on, the worse it will be whenever the music stops. So, you ask, how do we protect ourselves if we think that Michael Burry has a point? First, you don't buy passive index funds, of course. Instead, you can have individual stocks, and yes, that stock could be in the S&P 500, but also consider if you can find stocks outside of the index. For instance, many value stocks are not included in those power indexes. And I know I'm talking my position, but I'm pretty bold on value to perform well compared to the markets the next few years. So if you agree with Michael Burry about a bubble being built on passive index funds, I think that's worth a consideration. Now, also to your other point, Sebastian, does that mean that Warren Buffett is wrong whenever he suggests investors to buy passive managed ETFs tracking the market? What he's saying is that unless you're qualified to make investment decisions and know how to value both the market and individual stocks, you should just invest in the market using a cheap investment vehicle, such as an ETF, because in the long run, whether we're in a bubble or not, you will get the market return. And yes, the market return won't give you a fantastic Warren Buffett type of return, but a decent return without the stress about whether we're in the bubble or not. And also keep in mind that we had very smart people before the crash in 2008 that both said that the market would go higher and lower. And in March 2009, when the market bottomed out, we still had very smart people arguing that it will go in either way. It could go higher or lower. So I still think Warren Buffett's advice is very solid for the vast majority of investors who can't or won't make investment decisions away from the stock market overall and who do not pay attention to what Michael Burry is saying or if we are indeed in a bubble. Long term, you will just do fine with that investment approach that Warren Buffett suggests.
Well, I love the question, and to be quite honest with you, I thought the same thing as you. I was kind of raising an eyebrow saying, well, that's an interesting take. And it's not a new take. You had Carl Icahn that was saying something similar back in 2015, I want to say. And it was funny because the CEO of BlackRock, Larry Fink, he came out and slammed Icahn saying, that's a bunch of crap and here's all the reasons why. And I'm sure if you did a little bit of digging, you could uncover a few videos of that exchange, which happened well before Michael Burry's comment here recently. And I just don't know that I have a good answer for you. Where I think that there's more systematic risk with what's going on is much more in the bond market and in the currency markets. So my point of view is that you can continue to do quantitative easing, you can continue to do all these things that central bankers are doing, but where I think you start to hit a backstop and where you start to hit a wall is in the fixed income bond market. And so as central banks continue to push those interest rates lower and lower through quantitative easing, and now they're doing it on the shorter end of the bond yield curve in the repo market, it's all quantitative easing, and all it's doing is it's continuing to push the yield of the bonds down to 0%. Now, over in Europe, over in Japan, all these different spots in the world, major economies, you're starting to see the interest rates bottom out at 0%. They can't go any lower. They're trying to push them negative, and it's not looking pretty whenever they do. Here in the United States, you still have some positive interest rates. So where I think that this is playing out much more so than maybe the ETF market, I think all the thing that's going to happen with the ETFs is that you're just going to see the movements be that much more abrupt whenever they do occur. I don't see the ETF being the cause, though. I see the central bank interaction pushing interest rates down to 0% and trying to make them go negative becoming much more of the issue, because you start to hit a limitation on how much Ray Dalio calls it pushing on a string. So when you get to a position where currencies are going to have to be devalued in a major way in order to account for this, and that's how I see this playing out, and you're going to have to see, and if they do that with currencies, that means interest rates on fixed income bonds have to go up, which would then drive equities down. I think that what you're going to see the ETFs being this vehicle that provides a massive push to that more fundamental problem or more systematic problem that's playing out. So really hard to say. Sting and I we keep on trying to find good undervalued picks, stuff that we were talking about with David today. Good undervalued picks that have good fundamentals that would be able to weather something like that because they have a good, strong competitive advantage and they're adding value in the marketplace. We're just trying to find those kind of companies and highlight them to all of our listeners, but then also talk about these macro factors so that everyone's aware as to what's happening in the market.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.